Forex Fundamentals and Trading. Chapter 4 Market Participants. Section 1 Central Banks. Central banks sit at the center of a country's monetary system, but they are not ordinary banks that serve households at the branch level. Their job is to manage the currency and help shape overall financial conditions for the whole economy. One of their main tools is influence over the money supply and very short-term interest rates. By adjusting those conditions, they try to support stable prices, smoother financial functioning, and a more predictable economic environment. In Forex, that matters because a currency reflects confidence in the country's policy framework as much as current growth. When traders talk about central banks, they are really talking about institutions that influence the entire backdrop behind exchange rates. Although central banks share similar tools, their mandates are not identical. Many place price stability at the top of the list because high and unpredictable inflation damages savings, planning, and investment. Some also have an explicit employment objective aiming to support a strong labor market alongside stable prices. The U.S. Federal Reserve is a well-known example of a dual mandate, while others, such as the European Central Bank, place primary emphasis on inflation control. That difference matters because the same inflation reading can lead to different policy reactions in different countries. For traders, understanding the mandate helps explain why one central bank sounds more aggressive than another. It gives context to every rate decision, statement, and forecast. A central bank does not directly choose the interest rate on every mortgage, credit card, or business loan. Instead, it sets or guides a policy rate that affects the shortest end of the market, and that influence spreads outward. When policy rates rise, borrowing generally becomes more expensive, which can slow spending, investment, and inflation pressure. When rates fall, credit tends to become cheaper, which can support growth and hiring. The key idea is transmission rather than direct control. A homeowner, a company, and an investor may all feel the effects differently, but the starting point is the same policy signal. In Forex, higher expected rates often make a currency more attractive, while lower expected rates can do the opposite. One way central banks keep market rates close to their target is through open market operations. If the central bank buys government securities, it adds reserves to the banking system, and that usually puts downward pressure on short-term rates. If it sells government securities, it drains reserves, which tends to push short-term rates higher. This is less about dramatic market intervention and more about fine control over banking system liquidity. You can think of it as steering conditions in the money market, so overnight borrowing stays near the desired level. That helps the policy rate become real, not just theoretical. For traders, it is a reminder that rate policy depends on implementation as well as announcements. Once short-term rates shift, the effects begin moving through the broader financial system. Banks may change loan and mortgage pricing, bond markets may reprice, and exchange rates may adjust almost immediately. Companies may borrow less if financing becomes more expensive, and households may spend differently when monthly payments rise. Asset prices can also react, because the value of stocks, bonds, and property depends partly on interest rates. This chain of effects is called the transmission mechanism of monetary policy. It is one reason Forex can react before the real economy does, because markets reprice expectations quickly. Economic behavior then follows with a lag. Markets care about today's rate decision, but often they care even more about what comes after it. That is why central bank communication can move prices sharply, even when the rate itself does not change. Statements, press conferences, meeting minutes, and speeches all help shape expectations about the future path of policy. A small wording change can tell markets that rates may stay high longer, or that cuts might come sooner than expected. Bond yields, stock prices, and currencies can all react to that shift in expectation. In practice, traders are constantly comparing what the central bank says with what the market had already priced in. The surprise is often more important than the headline. Central banks also play a crucial stabilizing role during periods of financial stress. If a bank is fundamentally solvent but temporarily cannot access normal funding, the central bank can lend against eligible collateral and provide short-term liquidity. The goal is not to rescue every weak institution, but to stop a liquidity problem from turning into wider panic. That distinction matters. A solvent bank may have good assets, but still face a temporary cash squeeze. By acting as lender of last resort, the central bank helps protect the payment system and reduce the risk of contagion. In times of stress, this support can calm markets far beyond the banking sector. Forex traders watch this closely because confidence in the financial system affects the currency itself. Monetary policy can lean in two broad directions depending on the economic problem at hand. Expansionary policy lowers rates or adds liquidity when demand is weak, unemployment is rising, or the economy needs support. Contractionary policy raises rates or removes liquidity when inflation is too high or growth is running too hot. The tools may look similar, but the objective is different. One stance tries to stimulate borrowing and spending, while the other tries to cool them down. For traders, the important question is not simply whether policy is loose or tight, but whether it is becoming looser or tighter relative to expectations. Currencies often respond to that change in direction. Even powerful central banks cannot solve every economic problem. Monetary policy works with delays, sometimes taking many months before its full effect shows up in spending, hiring, and inflation data. It also cannot directly fix supply shocks such as an oil spike, shipping disruption, or crop failure. Central banks do not control government tax and spending decisions either, so fiscal policy may push in a different direction. This means they influence inflation, but they do not control every cause of it. That is why policy debates are often more complicated than a simple rate hike versus rate cut story. For traders, overestimating central bank power can lead to overly simple market assumptions. The Federal Reserve in 2022 offers a clear example of how all of this works in practice. U.S. inflation had moved above 8%, while the labor market remained strong. So the Fed began tightening policy in March by lifting rates from 0.25% to 0.50%. Just as important, it signaled that more increases were likely. Markets responded not only to that first step, but to the expected path of many future hikes. Borrowing costs rose across the economy, especially in rate-sensitive areas like housing and business investment. Over time, inflation came down, while parts of the economy cooled. The lesson for traders is that the expected policy path can reshape markets long before the full economic effects appear. Several common mistakes can make central bank analysis more confusing than it needs to be. One is treating a central bank like a commercial bank, even though their roles are completely different. Another is assuming a rate change works instantly, when in reality the effects spread with long and uneven lags. It is also a mistake to focus only on the current decision and ignore expectations about what comes next. Markets often move most when the future path changes, not when the current move was already expected. And finally, central banks do not fully control inflation, especially when supply-side forces are driving it. Keeping those limits in mind makes policy analysis much more realistic as we shift to the private banking system. Section 2. Commercial banks. Commercial banks are the institutions most people interact with directly in everyday finance. They take deposits, make loans, and move money through the payment system for households and businesses. Unlike central banks, they are private firms that aim to earn profits while managing risk. In practical terms, they connect savers who want safety and access to their money with borrowers who need funding for homes, cars, payroll, or expansion. They also help keep the economy functioning by settling payments and extending credit. In the Forex world, large commercial banks are especially important because many of them are major dealers in currency markets. So they are both everyday financial intermediaries and major market participants. A bank's basic business model is called intermediation. It takes in deposits, which are liabilities, because the bank owes that money back to customers, and it uses those funds to make loans, which are assets because they generate income. If the bank earns more interest on loans than it pays on deposits, the difference helps drive profit. That difference is often called the net interest margin. For example, if a bank lends at 6% and funds itself at 2%, that spread helps cover costs, losses, and shareholder returns. Of course, the process is not risk-free because borrowers may default and depositors may withdraw funds. But this simple balance sheet logic sits at the core of commercial banking. Profitability is only part of banking. Liquidity is equally important. A bank may have valuable long-term assets, but it still needs ready cash or reserve balances to meet withdrawals, payments, and settlements as they happen each day. Customers expect transfers to clear, debit cards to work, and cash to be available on demand. That means banks must manage day-to-day funding carefully, even while much of their asset book is tied up in longer-term loans. A bank can look healthy on paper and still face trouble if it cannot meet immediate cash needs. This is why reserves and other liquid assets matter so much. Banking is partly about earning from long assets, but also about surviving short-term cash demands. Because payment flows change constantly, some banks finish the day with extra reserves while others come up short. The interbank market allows them to lend reserves to one another, often overnight, to smooth those imbalances. A bank with excess reserves can earn a return, and a bank with a shortfall can meet its obligations without disruption. These trades are a key part of short-term money markets, and they help keep the payment system functioning smoothly. They also play an important role in transmitting central bank policy, because overnight funding conditions affect the rates banks actually face. In other words, the interbank market is where liquidity management becomes real. It links central bank intentions to commercial bank behavior. Commercial banks also earn money in ways that go beyond plain lending. Many provide foreign exchange services, trade finance, debt underwriting, and hedging products for corporate clients. For example, an exporter may need currency conversion, a guarantee for international trade, or a swap to manage interest rate risk. Banks charge fees for these services, which helps diversify their income away from pure interest spreads. This matters because lending profits can rise and fall with the rate cycle and with credit losses. Fee-based business gives banks another source of revenue and often deepens client relationships. In market terms, it also places banks at the center of many corporate transactions that eventually influence FX, bond, and derivative markets. It is important not to confuse reserves with capital because they solve different problems. Reserves support liquidity, meaning the bank's ability to settle payments and meet short-term cash needs. Capital supports solvency, meaning the bank's ability to absorb losses if loans or other assets decline in value. A bank can have enough cash today but still be undercapitalized if its assets are weak. It can also have a solid capital base but still run into funding trouble if cash outflows arrive too quickly. Healthy banks need both liquidity and capital. Mixing them up can lead to serious misunderstanding about what a bank problem really is. Banks do not lend without limits, even though making a loan often creates a matching deposit. The first constraint is settlement. Once that deposit is spent, funds may move to another bank, creating reserve needs. The second is regulation, because capital and liquidity rules limit how fast a bank can expand its balance sheet. The third is demand from creditworthy borrowers, since a bank cannot safely grow by lending to weak borrowers just to create assets. This is why the idea that banks can simply create infinite money is misleading. They can create deposits through lending, but they do so within a framework of funding, regulation, and credit risk. For traders and investors, that matters because credit growth affects the whole economy. The banking process becomes easier to understand when you follow it step by step on the balance sheet. A bank may first receive a deposit, which increases both its reserves and its deposit liabilities. It can then make a loan and credit a customer account, expanding both assets and liabilities again. After that, it must pay attention to reserve and settlement needs, especially if those funds are transferred elsewhere. If reserves come under pressure, the bank may borrow in the interbank market to bridge the gap. As the balance sheet grows, it also has to monitor capital so that losses can be absorbed if loans weaken. This sequence shows that banking is a constant balancing act between funding, lending, liquidity, and solvency. A simple reserve shortfall example shows how quickly liquidity pressure can appear. Suppose a bank has deposits of £500 million, reserves of $50 million, and loans of $450 million with a 10% reserve requirement. At that point, it exactly meets the required reserve level of $50 million. If a £10 million payment leaves the bank, reserves fall to $40 million, and the bank is suddenly short. To close the gap, it may borrow $10 million overnight in the interbank market at 0.75%. Nothing dramatic happened to its loan book in that moment. The pressure came from payment flows. This is why daily liquidity management is such a central part of banking. Even small overnight funding costs matter when they repeat day after day. On a £10 million overnight loan at 0.75%, the daily cost is only about £205, which sounds minor in isolation. But if reserve pressure persists, those costs accumulate and begin to affect profitability. A bank may respond by trying to attract more deposits, raising what it offers savers, or reducing how aggressively it lends. It may also choose to hold more liquid assets, so it is less exposed to future shortfalls. Over time, that can tighten credit conditions for the broader economy. So, overnight rates matter not because one day is huge, but because repeated funding pressure changes bank behavior. Section 3. Hedge funds. Hedge funds are pooled investment vehicles that collect money from investors and then deploy it using a broad range of trading strategies. What makes them distinctive is flexibility. Unlike many traditional funds, they can trade across asset classes such as stocks, bonds, currencies, commodities, and derivatives. They often have the ability to short sell, use leverage, and express both bullish and bearish views at the same time. That freedom gives them more ways to seek returns, but it also increases complexity and risk. In market terms, hedge funds are important because they often move quickly and trade in meaningful size. Their actions can have visible effects on prices, especially in less liquid markets. Compared with traditional mutual funds, hedge funds usually operate with fewer portfolio restrictions and target more sophisticated investors. They often have greater freedom to borrow, short assets, concentrate positions, or pursue niche strategies. Access is typically limited to accredited investors or institutions, rather than the general public. They also tend to disclose less about their holdings and may report with less frequency. That lower transparency can make them harder for outsiders to analyze in real time. At the same time, they are often more actively managed and more willing to take highly specific views. For traders, this means hedge funds can be both influential and difficult to read from the outside. Many hedge funds are not trying merely to beat an index. They are trying to generate positive returns under a wide range of market conditions. This is often described as an absolute return mindset. To do that, they may hold long positions that benefit if prices rise, and short positions that benefit if prices fall. A manager might be bullish on one company or currency and bearish on another at the same time. That allows the portfolio to express relative views rather than simple market direction. For example, a fund might like US rates relative to European rates, or one stock sector relative to another. The core idea is flexibility in pursuit of returns, not passive exposure to the market as a whole. Hedge fund strategies come in several common forms, each built around a different source of opportunity. Long-short equity funds buy stocks they expect to rise and short stocks they expect to fall. Global macro funds trade large economic themes, such as rate cycles, inflation trends, or currency shifts across countries. Event-driven funds focus on specific corporate situations like mergers, restructurings, or spin-offs. Arbitrage strategies look for temporary pricing gaps between related assets and try to profit as those gaps close. These approaches can look very different, but they all rely on active judgment rather than passive ownership. In Forex, global macro and relative value strategies are especially relevant because they often target cross-country policy and valuation differences. A hedge fund usually follows a repeatable operating process even if its trading style is highly flexible. It first raises capital from investors, often through a partnership structure in which the manager runs the fund on the investor's behalf. The manager then selects a strategy, sizes positions, and decides how much risk to take. Trades are often executed through a prime broker, which may provide financing, securities lending, and settlement support. Along the way, the fund monitors exposures, manages risk, and tracks performance. Investors then receive reporting on returns and fees. So while the trading may look fast and opportunistic from the outside, the business itself runs on a structured institutional process. Hedge funds are also known for their fee structure and frequent use of leverage. A classic model is a management fee of around 2% of assets plus a performance fee of around 20% of profits, though actual terms vary. That means investors may pay for access to skill and flexibility, but high fees can reduce net returns if performance is only average. Many hedge funds also borrow money or use derivatives to increase market exposure beyond their capital base. Leverage can amplify gains when the trade works, but it amplifies losses just as quickly when the trade moves the wrong way. A 10% market move can become far more painful if exposure has been multiplied. This is one reason hedge fund risk management matters so much. Consider a simple leveraged long-short example. A fund starts with $500 million in capital, takes a $150 million long position in TechCo, and a $25 million short position in RetailCo. Because the short offsets part of the long, the net market exposure is $125 million. If part of the TechCo long was expanded using borrowed money from a prime broker, the fund has increased the size of the outcome without adding new investor capital. The trade expresses both a directional and a relative view, confidence in TechCo and weakness in RetailCo. Even though the net exposure is smaller than the gross positions, the individual trades still matter a lot. This is a good example of how hedge funds use structure to shape return potential. That same structure can generate strong profits or equally sharp losses. If TechCo rises and RetailCo falls, both sides of the position help, and the fund may earn a $35 million profit. If TechCo falls and RetailCo rises, both sides hurt, and the result can be a $35 million loss. The important lesson is that long and short positions both drive performance. Many beginners assume the short side is just a hedge, but it can be a major source of return or loss on its own. Add leverage, and outcomes become even larger relative to capital. Conviction can be valuable, but when combined with borrowed exposure, it can become dangerous very quickly. Hedge funds matter in markets because they often trade actively, quickly, and in meaningful size. A large order can move price, especially when liquidity is thin and the order book is not deep. If many funds crowd into the same short trade, they can add substantial selling pressure. If they all try to exit at once, the reversal can be violent, creating sharp swings in price and volatility. Their actions also affect banks, corporations, market makers, and other investors who share the same market. In some conditions, hedge funds add liquidity, but in others, they intensify moves. For Forex traders, understanding where hedge fund positioning may be concentrated can help explain sudden momentum or instability. The same flexibility that gives hedge funds opportunity also creates real vulnerabilities. Too much leverage can turn a small market move into a damaging loss. Illiquid positions can look manageable in calm markets, then become very hard to exit when stress hits. Concentrated portfolios may perform well for a time, but a single adverse shock can hurt the entire fund. Margin calls add another layer of danger, because falling asset values can force the fund to sell into weakness just to meet financing demands. That is why risk control is not a side issue in hedge funds. It is central to survival. As we move from investment funds to operating businesses, the contrast becomes clear. Corporations usually come to markets for stability, not for aggressive return seeking. Section 4. Corporations. Corporations usually use financial markets to support the real business rather than to speculate for short-term gain. They may raise capital, manage risk, invest temporary cash balances, or participate in markets as part of routine treasury operations. A company might issue bonds to fund expansion, hedge a foreign currency receivable, or place surplus cash in short-term instruments. In that sense, it can be both an issuer and an investor depending on what the business needs at the time. The motive is usually operational efficiency and financial stability. That makes corporate activity different from hedge funds, which are primarily return-seeking. In markets, corporate flows often reflect practical business needs rather than market opinions. Most corporate market activity is tied directly to real exposures created by the business. An exporter may hedge foreign currency revenue, so exchange rate swings do not distort earnings. A company with floating rate debt may hedge interest rate risk to make future financing costs more predictable. A manufacturer might hedge commodity inputs, such as oil, copper, or wheat, to reduce the risk of sudden cost spikes. Treasury teams may also decide how to invest excess cash or whether to repurchase shares. All of these decisions are linked to operations, cash flow, and capital allocation. A common goal is not to outperform the market, but to make business outcomes more stable and manageable. When corporations need long-term funding, they often turn to capital markets as issuers. If they issue equity, they raise capital in exchange for ownership, which increases the supply of shares in the market. If they issue debt, they borrow from investors by selling bonds, adding supply to credit markets instead. Each path has different implications for investors and for the company's balance sheet. Equity does not require fixed repayment, but it dilutes ownership. Debt preserves ownership, but it creates repayment obligations and interest costs. For markets, these issuance decisions matter because they can affect pricing, supply, and investor demand in both stocks and bonds. Corporate finance decisions are therefore a direct source of market flow. On the asset side of the balance sheet, corporate treasury teams usually think conservatively. If the company has surplus cash, the priority is typically capital preservation, liquidity, and low risk rather than chasing yield. That is why cash is often placed in instruments such as treasury bills, money market funds, or other high-quality short-term securities. At the same time, treasury teams may use derivatives such as forwards, futures, swaps, or options to hedge specific exposures. The aim is to reduce uncertainty in future cash flows, not to maximize trading profits. For example, a firm may lock in an exchange rate or convert floating debt costs into fixed ones. Good treasury management helps the business plan with more confidence. The line between hedging and speculation is one of the most important distinctions in corporate finance. A hedge offsets an exposure the business already has, such as future euro revenue or variable rate borrowing costs. Speculation, by contrast, adds exposure in the hope of profiting from a market view. The danger is that a hedge can turn speculative if it becomes larger than the underlying business risk. For example, if a company expects 1 million euros of revenue but sells 2 million euros forward, the extra amount is no longer protection, it is a bet. That can create losses instead of reducing risk. Good governance asks a simple question: are we reducing an exposure or taking one? Corporate flows can influence markets in several different ways. Share buybacks create demand for a company's stock, while new equity issuance adds supply. Bond issuance adds supply to credit markets and can affect pricing for similar borrowers. Corporate hedging and merger activity can also create sudden, meaningful flows in currencies, rates, or equities. These flows are often tied to business calendars, financing windows, or transaction deadlines, so they may occur even when market conditions are unfavorable. That is important for traders because corporate activity is not always price sensitive in the same way speculative activity is. In some situations, those flows can become a significant short-term driver of price action. Corporate market behavior is constrained by law, regulation, and internal controls. Insider trading rules prevent companies and employees from trading on material, non-public information. Disclosure rules govern what firms must communicate to the market and when they must communicate it. Boards and treasury policies often define which instruments can be used, which counterparties are acceptable, and what the purpose of trading must be. Accounting treatment, risk limits, documentation, and audit trails also matter because poor control can turn a hedge into a reporting problem. In other words, companies do not operate with unlimited discretion. Their market participation sits inside a framework designed to protect both the firm and the market. A practical example makes this more concrete. Imagine a US electronics manufacturer that expects euro and yen receipts from overseas sales, faces copper costs in production, and is temporarily holding excess cash. Treasury might use FX forwards to lock in the dollar value of those foreign revenues and copper futures to stabilize input costs. At the same time, it could place spare cash in 90-day treasury bills to preserve liquidity and safety. None of these actions are about beating the market. They are about making revenue, costs, and cash management more predictable. For a business with thin margins or large operational needs, that stability can be more valuable than upside speculation. Consider a Canadian exporter expecting $20 million in 6 months. If the company stays unhedged and the future spot rate is 130 Canadian dollars per US dollar, it receives 26 million Canadian dollars. If instead it hedges today at a forward rate of 121, it unlocks in 25.6 million Canadian dollars. The unhedged outcome is higher in this scenario, but it was also uncertain the whole time. The hedge gives up some potential upside in exchange for certainty. That trade-off is the essence of many corporate hedging decisions. Treasury teams often prefer a known outcome they can plan around, rather than a better outcome that only appears by chance. Corporate market use often goes wrong when discipline fades. One mistake is treating hedging as a profit center and gradually drifting into speculation. Another is ignoring counterparty risk. as though a hedge is guaranteed to work even if the bank or trading partner fails. Over-hedging is also dangerous because a forecast may not materialize, leaving the company exposed in the wrong direction. Execution errors and accounting problems can create damage too, even when the underlying hedge idea was sensible. Effective treasury work is usually quiet, controlled, and tightly linked to real exposures. That is a useful contrast as we turn to retail traders, who participate with personal capital and very different constraints. Section 5. Retail traders. Retail traders are individuals using their own money to participate in financial markets. They are not acting on behalf of a bank, hedge fund, or corporation, and their position sizes are usually much smaller than those of institutions. That smaller scale changes almost everything: access, pricing, execution quality, research resources, and risk tolerance. Retail traders may still operate in the same markets as institutions, but they do not play the same role within the system. Their decisions are personal rather than organizational. In Forex, this means they are usually price takers rather than price makers. Understanding that difference helps set realistic expectations from the start. Most retail traders access markets through an online broker rather than trading directly in the professional market structure. The broker provides the account, trading platform, charting tools, and order entry system. Once the account is funded, the trader can analyze markets, build watch lists, and place orders from a desktop or mobile device. Many brokers also offer margin, which allows traders to control positions larger than their cash balance. Behind the scenes, the broker routes orders for execution through market makers, exchanges, or liquidity providers, depending on the product. This setup makes market participation convenient, but it also means execution quality depends partly on the broker's model. For beginners, the broker is the gateway to the market. Retail traders commonly participate in markets that modern broker platforms have made easy to access. Stocks and ETFs remain popular because they are familiar and relatively simple to understand. Forex attracts traders interested in macro themes, leverage, and around-the-clock access during the business week. Options appeal to those looking for defined risk structures or directional trades with less cash upfront, though they add complexity. Cryptocurrencies have also drawn strong retail interest because access is easy and price moves can be dramatic. The important point is that technology has reduced the friction of getting involved. Access is no longer the hard part. Disciplined participation is. Retail trading has become much more visible because the barriers to entry have fallen sharply. Commission-free apps lowered explicit trading costs, lower account minimums widened access, and fractional shares made it possible to invest or trade with very small amounts of money. Social media and mobile platforms also made trading more public, more frequent, and more connected. One small trader usually cannot move a major market, but a large crowd acting together can influence thinner markets or short-dated products. That is why retail flows have shown up in small-cap stocks, options, and some crypto markets. Lower friction brought more participation, and more participation made retail activity more visible. But easier access does not remove market risk. Retail traders face several structural disadvantages compared with larger institutions. Smaller capital means less diversification and less room to absorb mistakes. Wider spreads and commissions, where they exist, can make short-term trading more expensive than it first appears. Slippage can also hurt, especially in fast or illiquid markets, because the actual fill may be worse than the expected price. Most retail traders work with less advanced data, weaker analytics, and fewer research resources than professional desks. On top of that, behavioral mistakes such as overtrading or chasing moves often do as much damage as market direction itself. So retail trading is accessible, but it is not an even playing field. Being small does come with some real advantages. A retail trader can enter or exit a modest position quickly without attracting attention or moving the market. There is no committee, investment mandate, or approval chain slowing down the decision. That flexibility means a trader can choose only the setups they want and can simply stay out when conditions are poor. Small size also makes it easier to trade around niche opportunities that would be too small to matter for a large institution. In some situations, that agility is a genuine edge. The key is using smallness as a strength rather than trying to imitate institutional size. A disciplined retail trading process is usually simple, but it needs to be deliberate. It starts with choosing a broker, opening the account, and funding it properly. Before any trade is placed, the trader should analyze the market and define the setup clearly, including entry, invalidation, and target. The order itself should include risk controls, such as position size and a stop loss that matches the plan. After entry, the job is to monitor the trade without abandoning the original logic at the first emotional swing. Once the trade closes, a review helps identify what was done well and what should improve. In practice, consistent review often matters more than constant prediction. Order choice affects both execution and risk. A market order prioritizes speed and seeks immediate execution at the best available price, which can be useful when entering or exiting fast-moving markets. A limit order gives more price control because it will only execute at the chosen price or better, but it may not fill at all. A stop-loss order is designed to cap downside if the trade moves against you, while a take-profit order closes the trade once a target is reached. These tools help turn a trade idea into a structured plan, rather than an emotional reaction. For retail traders especially, the difference between a controlled loss and an uncontrolled one often comes down to order discipline. Good execution begins before the trade is live. Maria's options trade is a good example of discipline in action. With a $0 account, she buys just one AAPL call after earnings rather than taking an oversized position. She enters with a limit order at a $450 premium. So the cost is $450 for one contract controlling 100 shares. Before entering, she defines a stop loss at 320 VIRs for one contract controlling 100 shares. Shrewd and a take profit at 700, which means both risk and reward are planned in advance. Her maximum planned loss is $150, or about 1.5% of the account, which keeps the trade small enough to survive. When the option closes above her target, the profit is the result of process as much as prediction. The lesson is that position size and risk control matter just as much as the market call.